Imagine logging into your brokerage account and seeing an absolute blue-chip powerhouse down nearly 70%. Today, we are opening the books and performing a complete financial autopsy on Nike. Is the swoosh permanently broken, or are we looking at a generational buying opportunity? Let's jump straight into the numbers.
Negative 67.86%. Man, that is a violent, just devastating 5-year wipeout. Seeing a stock chart for a historic, global consumer brand plummet almost 70% in a straight line down is brutal. And honestly, it forces us to ask a really important question right out of the gate.
Look at the sheer scale of the damage we're dealing with here. Year-to-date performance, down over 32%. The one-year drop, over 31%. A drop this steep really begs the ultimate question. Is Wall Street just completely overreacting and handing us a rare generational buy? Or are the underlying business fundamentals structurally broken? Let's find out.
So we've got to start with the top line, because the growth engine here has officially stalled out. Just notice the sheer speed of this drop. Revenue climbed steadily to an all-time peak of $51.36 billion in 2024. But look at 2025. Revenue plummeted to $46.30 billion. That is a massive $5 billion wipeout in a single year. And you don't lose $5 billion in sales without heavily discounting your merchandise. Just picture rack after rack of unsold shoes.
Okay, before we go any further, let's quickly define net margin, just so we're all on the exact same page. Simply put, this is the percentage of revenue a company actually gets to keep as profit after every single expense is paid. It's not about how much you sell, right? It's about how much you keep. It is a true measure of operational efficiency.
And when top-line pain meets bottom-line reality, well, you get the margin squeeze. Gross margins are down. Operating margins literally halved, dropping from 15.58% to just 7.99%. And that net margin we just defined has been completely crushed, falling from nearly 13% in 2022 to under 7% today. The underlying business is actively bleeding profitability.
So the absolutely crucial question is this margin squeeze just a temporary macroeconomic blip, or are we looking at a terminal red flag for the brand? Oh, and hey, real quick, if you're finding this financial breakdown helpful, make sure to hit that like button and subscribe to Stoxcompare right now. It really helps us bring these objective explainers directly to you. Okay, let's pivot to the absolute lifeblood of any business, and that lifeblood is free cash flow. Just as a quick refresher, free cash flow is the actual cash a company generates after accounting for all the outflows needed to support its operations. Why does this matter so much? Because while earnings can sometimes be manipulated by, clever accounting tricks, cash doesn't lie. You either generated it or you didn't.
And unfortunately for Nike, that cash is drying up fast. Across the board, it's just a sea of red. Net income dropped 43%. Net cash from operations is down a staggering 50%. And check out the free cash flow. It perfectly mirrors the operational drop, getting sliced in half from $6.61 billion in 2024 to just $3.26 billion in 2025. The actual cash-generating power of Nike was essentially cut in half.
So what exactly is management doing to stop all this bleeding? Well, they're trying to shrink the float. Over the last few years, they have successfully shrunk the outstanding share count down to 1.485 billion shares. By reducing shares, your individual slice of the pie gets slightly bigger. But here's the catch. Even with those buybacks, overall capital return has steadily dropped since its 2023 peak, simply because, the cash flow has dried up.
Now that cash flow drought brings us directly into what I call the dividend danger zone. Back in 2024, Nike had a healthy payout ratio of about 32%. Today, that ratio has spiked to an alarming 70.38%. Nike is now spending over 70% of its shrinking free cash flow just to cover a steadily rising $2.3 billion dividend expense. Now, the dividend is still being paid for sure, but that safety buffer is vanishing dangerously fast.
Section 2, the turning point, finding the bottom. All right, so after seeing all that operational bleeding, let's take a look at the underlying foundation to see if we can actually find a bottom here. Is Nike at risk of bankruptcy, or is it a financial fortress? Well, the good news is pretty clear here. Nike is sitting on a massive $9.15 billion in cash and equivalents. Their working capital ratio sits at a super healthy 2.21, meaning they have more than double the liquid assets needed to cover their short-term liabilities. So the verdict here? While operations are struggling, the balance sheet is an absolute fortress. Financial survival is definitely not the issue.
Which brings us to valuation. And to fully grasp this, we need to quickly define the price-to-book, or PB ratio. This compares a company's market value to its actual book value. Basically, what it would be worth if you liquidated all the assets and paid off all the debts. When you see a violently shrinking multiple here, it signals that speculative market froth is disappearing.
And wow, has the froth disappeared for Nike? Historically, this stock traded at massive premium multiples, nearly 19 times its book value back in 2020. That is incredibly high. But today, as operations have cooled off, that multiple has violently compressed to just 6.76 times book value. The premium is gone. The market has completely reset its expectations from priced for perfection to priced for pain.
So let's bring it all together for the Stoxcompare verdict. Is Nike a turnaround play, or is it just dead money? On the bad side, operations are seriously wounded. A 10% revenue drop, halved net margins, and crushed free cash flow. But on the good side, the foundation is rock solid. We're talking a $9 billion cash pile, reduced debt, and a compressed valuation multiple that removes a whole lot of downside risk. Our conclusion: this is not a value trap destined for bankruptcy. It is a high-risk turnaround play. It's a classic show-me stock relying entirely on management stabilizing those margins.
And hey, remember, this explainer is purely analytical, right? Definitely not financial advice. But I really want to hear from you. After seeing the books wide open, the operational struggles versus that fortress balance sheet, are you buying this dip, or is the swoosh fundamentally broken? Drop down into the comments right now and let me know your thesis. Thanks for joining me on this explainer, and I'll see you in the next analysis.